Good morning, ladies and gentlemen. Well, another week and the risk dial still cannot go positive, even though equities are acting pretty well. To me, that is pretty stunning. We started the week, -1, went to -13, -1, and even though Friday was a pretty good day for equities, there was not much damage. We still ended up at -17. This is pretty ominous. A big move is coming, that's for sure, and the risk dial is still giving you higher odds of being in bonds rather than being in equities. Never forget that this is a relative score, it's not an absolute score. So it's just saying that risk off and bonds are still likelier to perform better going forward rather than equities. If we have a look at the deviations, we will just see that we are in no man's land and we really don't have much resistance until new highs, just above new highs, and really no support till we get all the way down back and retest the lows that we made a couple of weeks ago. So it's going to be pretty interesting over the next couple of weeks, and especially with the Fed next week. That will give us the impulsion either to go and test this level here around the 29.70, or probably come all the way back down almost to retest the lows. But we will have a look at this in further detail in a second. It being Fed week next week, the things which are going to decide the pricing of everything are going to be the bonds, and especially the short end. If I do not expect the Fed to do anything, but they will definitely, I think, change the wording of the communique. If they remain very stiff and unwilling to ease, the 2-year note, I think, could go all the way up towards this 202 to 205 level, but that is about as far as I see it going, simply because the market will not stand for it for very long. If we can get anything between 195 and 205 in terms of shorting it, I will definitely do so, because the risk reward is still very much weighed towards being long of 2-year notes. Any kind of close now below these lows around the 180 level will take us very quickly all the way down towards 130. That is all that can be said about the 2-year note. The 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 German stuff is almost untradeable. You can see that we are now below the 20 basis points level that was the previous low. It is completely uncharted territory. There's not a lot I can say about it that makes any sense, because the technical situation in the bond market is such that there are no bonds to be traded. Basically, the ECB owns them all. When the if the ECB decides to do some switching or something to make the market more credible in Europe, no one knows. Nobody can be sure. It's the decision of a few people who are going to be tight-lipped about it. So what can you say about this market? Not a lot. You can just look at it. You can just look at what it's doing in terms of a spread against the 10-year note, and you can see that this spread is now coming in. It basically, to me, this is some kind of inverted head and shoulders, and to me we're going back up towards the minus 200 level, which would imply that bonds rally a lot less than 10-year notes, and that colors my opinion for a variety of assets. I want to have a look in detail at 5 and 10-year notes simply because it's Fed week and it's going to be very, very important. To me, this is a chart, a daily chart of the 5-year note. If we start breaking now above this 193, 194 level that we saw briefly last week, we could be going all the way back up to 213. But that is about as far as I can see this market going. I think it will fail somewhere around the 204, 205 area, and then it'll come back down. 161 is the target that I have, and after that we're looking at 145. To me, this is going to be a one-way street as soon as we reach some upside targets. Same thing for the 10-year note. I am finding it very difficult to see it back above 222, 220, 225, that kind of area. If we can get short of yields, long of 10-year note futures somewhere here, that would be great, because after that we are going to go all the way to 169. That is my immediate target in the 10-year notes, 169. And I've got that in the bias sheet that you'll see later on. So still my predilection and my bias is for lower yields. If we now actually change this and have a look at a weekly chart, you can probably see it even better. If we now trade up here, just below 220 and fail, I think that this 203 level will not hold it, and after that here we are, 169 on the weeklies. You can see how many times the market has done this kind of behavior. Went up, failed, come right back to 169. To me, 169 is going to be a very, very important level, and I think we will see it. This is a weekly chart of TLT, so I don't show you the bonds because I don't much like the pattern. This is much clearer. I think if something bad happens, 127.37, that is where we go down to, and then we spike all the way back up to 137. TLT to me, even with a bit of a dip here, all it's going to be doing is a cup and handle and back up towards this 137. I expect 137 to trade sometime this year without any problems. We are very overbought. This move back down towards 127 and a half, call it 128, something like that, would not be a surprise. But after that, 2 or 3 weeks of consolidation, I think we will power through and see 137 at some stage. Next week, equities should be much less volatile than bonds, certainly in terms of percentage moves. To the upside, we have the Bollinger Bands coming in around 29.70. What that would mean is that we would fill all the little gaps we have on the dailies around the 29.20 to 29.50 area, make a new high and probably stall out there. Makes fundamental sense to me. If on the other hand we break through the 28.64 level, we really have no good support until we get to the 28.20-ish area, where we have the support from the moving average. Below that, and we start looking ugly, because I don't think it'll hold 27.80. If it does hold 27.80, okay, then we trade sideways for a number of weeks, but it's still beginning to look very weak. And that is why I'm leaning towards believing the risk dial that the risk reward is still to be long of bonds rather than equities. I think the upside in equities is 2 to 3% maximum. If we look now at a at a daily chart, we can see that on the dailies, it's even more pronounced that really it's going to be very tough even to get to 29.50 and fill all these gaps, let alone get up to 29.70. While on the downside, I think we could very quickly, if we break this red moving average, and which now comes in at 28.64, it really will cascade very quickly, and I think all the way down to the 200-day, which is 27.75. We will hold this 27.75, 27.50 area for a bit, but it's beginning to look very heavy and ugly on the dailies and on the weeklies. And if we change this whole thing now and go to a monthly chart, and this is the monthly chart, you can see how it's actually matching here. Let's enlarge this. You can see that the support comes in around the 2800 area, below there, and you can see how there is absolutely nothing. We could easily go all the way down to 2540 and this Bollinger Band. So this month is going to be, the close of this month is going to be very much influenced by what the Fed does next week. Because if we have dashed expectations of a real easing in late July, then this picture could get very ugly, and really we are looking then for a retest of the lower Bollinger Band, which held so wonderfully in December and gave us the buy signal. If that happens, well, you can see where that is, 25.40. That's a pretty ugly picture. While the upside, even on the monthlies, the Bollinger Bands come in exactly where they come in on the weeklies, just above the previous highs. So even if the market makes new highs, it's likely to fade and trade sideways. The VIX has been particularly good in the past few weeks and months, showing you where the market is likely to go. This is now a weekly chart. You see we still have this gap here down towards the 1310 area, and that gap was created by the famous Trump tweet about China. The market hates gaps, and it is likely at some stage to fill it. Whether it fills it next week or not, I don't know. But the odds are slightly better, VIX is saying, that we fill this gap in the next couple of weeks, which would match up with the market going up towards the 2970 area. So it's 60-40, I would say, that we trade up in equities, equity price towards the 2970 area, and fail and fade there, as I've just shown you. This is a daily chart of VXX, which is the ETF of volatility. This confirms my view of the VIX actually filling this gap, which was created by the Trump tweet, down towards 2540. I'll put that in as a decent level to get out of any volatility shorts, 2542. This tells me again that both bonds and equities will go up over the course of the next couple of weeks. This matches that 2970 kind of objective, take out the highs, suck in longs, and then stop right there and reverse. Makes sense to me. That's why I'm not going to get short of equities. I'm marginally long, but more long of bonds. I think that makes more sense. Even if the Fed is not as accommodative as people expect, I think doubling up on bond position, taking it back up to a full position at the yield levels that I have shown in the bias sheet, is probably going to be a much better trade than getting long of equities around the 2950 area. Gold is still looking interesting. I think we're beginning to turn this 200-day moving average. I think we will have support around the 1310 area, If he gets down there, buying some short-dated calls could be, or even long-dated calls could be an interesting play. Uh, it, I have not changed my mind. You have to have a higher allocation to gold than zero. Do you need to have a huge allocation to gold? I don't know. Certainly not until it starts breaking this triangle to the upside and starts confirming. Don't forget that my view is that bonds are still going down in yield, and gold tends to trade as an inverse to real yields. Real yields are coming down, and therefore it's not a surprise that gold should go up. Now, will gold go up more than real yields come down? I have no idea. I prefer to be invested in bonds, though, than I prefer to be invested in gold. But a small allocation to gold, and as you know, a few weeks ago I upped it, a couple of weeks ago I upped it. It makes sense. To me, it makes sense that both gold and bonds go higher over the course of the summer. What to say about our friend DXY apart from 96.50 does the job? It's 96.47, but who cares? What's 3 ticks between friends? It's becoming even more and more and more significant, isn't it? It's a confluence of the 200-day moving average, the trend line, and the level. I can't really see this market doing much better in terms of the dollar, simply because I've shown you the chart of the 10-year against the bonds. When yield differentials come in, and also when the Fed goes into a cutting circle, the dollar starts getting affected sometime after the first cut. And I'm firmly of the opinion, which I've told you many times before, that when the Fed starts cutting, it ain't stopping. The market always, 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 in my experience, underestimates how many cuts there will be, because really 125 basis point cut, or 225 basis point cuts, or 325 basis point cuts don't do anything if we're going to go into a recession. There are no signs we're going to go into a recession, but when the Fed starts cutting and things start getting ugly, if they do get ugly, it's going all the way to zero and probably to negative yields. So I cannot be long of this, because the reward on the upside is just not good enough to start getting long at these levels at which it has always failed. All I can say is that if the dollar now starts going up and holding these higher levels, the Fed easing cycle will be accelerated, because whatever the Fed is giving with one hand, the dollar will be taking away with the other, and therefore I will get even more bullish of bonds, and I will be doubling up. So in a way, I am praying that I lose money on my dollar position, because I will be making it hand over fist on my bond position. Before I go, I wanted to show you this chart of DAX cash, because it's very interesting, isn't it? I think the DAX could make a new high and go up towards the 12,600, 12,700, much like the S&P, a marginal new high on the move. But it's very interesting that it's more than not likely to fail and then come all the way back down towards the 10,500 in the longer term. In the shorter term, should we have a pullback, these kind of levels between 11,700 and down here to 11,500 are going to be very interesting for buying some calls for a move back up. But it's this uptrend is getting tired. This could be a 1, 2, 1, 2, 3, 4, 4, 5 up here, around the 12,600, 12,700, and then we are ready to swoon back down, which is basically matching the view of the ES, and also my view of the bonds. Maybe we get a nice retracement that we can buy next week on the market going stupid and misreading the Fed statement. I don't know, but everything I look at, the spreads and everything else, tells me that it's right to overweigh your bond position, and that is where the best risk reward is going to come from. So on to the biases for next week. I've made them more legible. I've completely changed it. So 5 and 10-year notes, I've given you here all the levels on the upside for the 5s and the 10s. This is where you want to trade. How much you trade at each level is, I will tweet depending on what the Fed statement is. Naturally, this is all after the Fed statement comes out. You have the downside targets as well. To me, the 2-year note still has the best optionality. 196 to me is going to be good enough. If it gets to 205, 207, I will be orgasmic, because the downside, I am absolutely convinced that this year, and I'll put my cards on the table completely, I think this year we trade 130 in the 2-year note. Bobble and Bund, I've told you, untradeable. Just leave them alone. Just trade them on a spread against the 10-year note at the levels on the chart, and that's about as far as you want to go. SPX, I've told you, 2970 is the level on the both weekly and the monthly Bollingers. Any longs beyond there are, in terms of risk reward, just stupid. A break of 2864 will cascade. To me, the minimum on a close below 2864 that you will see is 2815, 2820. So that gives you a good 40 points. But it'll probably go to 2780 in a repeat of what we saw last time we broke the 2864 level. NQ, I still don't like it. It's still supposed to be the leader on the upside, and it's not. To me, SPX is a better bet than NQ, both on the upside and the downside. If you're long of SPX and shit happens, you will lose a lot less money than you will lose in NQ. And the upside is more or less 1-for-1 in both of them. So I don't see the point of the extra risk in NQ. RUT, I haven't shown you a chart of it because I don't want to bias anyone before the Fed decision, but I think this one will probably give you the best clue as where we are going after the Fed decision, and I'll be ready to tweet the levels for you then. The VIX, as I told you, is giving me a read that we are more likely to go up than down in equities next week, that the risk of seeing 2970 is higher than the break of 2864 and the cascade, but it's only 60-40, and that's not really a good enough odds to bet on very much. I told you European equities, I like the DAX around 11,750, 11,600. Better odds that we rally from there than not, but if we make the new highs, I told you the level 12,600 and to 12,700 is the level that you want to be out and no longer interested in DAX in the slightest, because the odds are very bad. The dollar, again, 96.50 continues to do its job. Patience here is what you want. Just stay, trade the dollar from the long side off 96.50 by all means, but a break and close below 96.50 is going to be so decisive, and the move down from 96.50 is going to be so strong that you just do not want to fight it. You want to go with it, maximum leverage. Thank you very much indeed, and tweet you on Monday.